In the United States, that limit is currently $250,000 per depositor, per bank. Look at this diagram. The bank sits in the middle. On one side, depositors bring their money in. On the other side, borrowers take money out. And surrounding the whole structure, like a safety net beneath a tightrope walker, the guarantee scheme holds the system in place. This is the mechanism that answers my original question most directly. We put money in banks not only because they hold it, not only because they pay us interest, but because that safety net exists. Without it, the rational response to putting money in a bank would be to constantly worry about whether the bank would still be standing tomorrow. With it, we do not have to. The deposit guarantee is the foundation of trust on which the entire banking relationship is built. And I found it quietly remarkable that I had relied on it, implicitly, every single day of my financial life, without ever knowing its name. Now I want to show you what this system actually looks like in numbers, using the real figures, not rounded, not softened, because the real figures are what make this concrete rather than theoretical. Let me walk you through a simple scenario that shows exactly how the money circulation system moves through an economy, and what role a single deposit plays in it. Imagine a deposit of $1,000 entering a bank. Watch this flow diagram as each step appears. The bank holds a reserve of 10%, $100. It lends out $900 to a small business owner who needs working capital. That $900 is spent at a supplier. The supplier deposits the $900 in their own bank. That bank holds $90 in reserve and lends out $810. Watch the counter at the base of this diagram as the process continues. By the time the circulation has run through its full cycle, that original $1,000 deposit has supported up to $10,000 in total economic activity. $10,000. From $1,000 deposited, not because money appeared from nowhere, but because each dollar, lent and spent and deposited and lent again, was used multiple times within the system before it came to rest. Now look at this second bar, building alongside the first. This bar shows the interest earned by the original depositor on that $1,000 over 12 months, at a standard savings rate of 4.5% annually, $45. And this third bar shows what the bank earned during the same period, the net interest margin from lending that $1,000 at a higher rate. The gap between your bar and the bank's bar is not a secret. It is the published business model of every commercial bank that has ever operated. Understanding it does not mean you are being taken advantage of. It means you understand the terms of the relationship you are already in. And understanding the terms of any relationship is how you make the most of it. I found that realization more useful than any financial tip I had ever been given, because it did not tell me what to do. It showed me how to see clearly. And before I get to what this understanding actually changed for me, there is one more thing I want you to hold in your mind as we get to the conclusion of all of this, because it is the part that I think matters most for anyone thinking about their own relationship with money. Here is what this journey through the banking system actually taught me. 3 things I now carry with me every time I interact with a financial institution. The first thing I learned is that every financial institution has a business model. And understanding that model is the single most clarifying thing I can do as someone who uses that institution. A bank pays you less for your deposit than it charges others for borrowing it. That is not a conspiracy. That is a business. Knowing it means I can evaluate whether the terms being offered to me are reasonable and look for better terms elsewhere if they are not. The second thing I learned is that my deposit is a choice, not a default. I put money in a bank because of specific things the bank provides: safety, accessibility, interest, and the guarantee scheme behind it. These are real, valuable things. When I deposit money, I am making an exchange, my money's temporary availability in exchange for those four things. Understanding that I am making an exchange, rather than simply following a habit I inherited, is the difference between being a passive participant in the financial system and an informed one. The third thing I learned, and this is the one I find most important, is that the banking system, at its core, is built on one thing above everything else: trust. Trust that the bank will honor its obligation to return my money. Trust that the guarantee scheme will hold if the bank cannot. Trust that the rules of the system will be enforced. Watch this final diagram as it assembles. Depositor, bank, borrower, guarantee scheme. Each element connected, each one dependent on the trust of the others to function. The entire edifice, every bank branch, every savings account, every mortgage, every business loan, rests on that single, quiet foundation. Here is what I want you to take from everything I have walked you through today. The question I asked sitting in my car, "Why do I put my money in a bank?" turned out to have a much richer answer than I expected. Not just safety, not just convenience, but an entire ecosystem of relationships between depositor and bank, between bank and borrower, between the whole system and the guarantee that holds it together, that makes modern economic life possible. I had been participating in this ecosystem for over 20 years before I understood what I was participating in, and that gap between participating and understanding is, I think, the most important gap in personal financial education. Not investment strategies, not tax optimization, not compound interest curves. The basic foundational literacy of understanding the institutions that sit at the center of every financial decision you will ever make. What I know now, that I did not know before I started asking this question, is that a bank account is not a passive storage container. It is an active relationship, one with terms, incentives, risks, and protections. And like any relationship, it is best entered with eyes open. The narrator's story does not end with a dramatic financial transformation. It ends with something quieter and more durable. The ability to look at a bank branch, the same one I had walked into hundreds of times without thinking calm, and understand, clearly and without anxiety, exactly what is happening inside it, exactly what my role in it is, and exactly what I am getting in return for showing up. I want to give that invisible process a name, because naming it is what makes it visible. And once you see it, you will not be able to unsee it when you look at your own account. I call it the money circulation system. Not because that is an official term, it is not, but because it is exactly what it is. Your deposit does not sit in a vault with your name on it. It enters a circulation, moving from depositor to bank to borrower and back again, generating value at every step of the journey. The money circulation system is the engine underneath the bank. And once you understand how the engine works, you understand your relationship to it with a clarity that most people never reach. Even people who have been depositing money their entire lives. Let me walk you through the first mechanism of how that circulation actually works. Because this is the part I found most surprising when I first looked at it properly. Think about the last time you took out a loan, a car loan, maybe, a mortgage, even a personal loan for something you needed at the time. Most of us assume that when we borrow money from a bank, the bank reaches into a vault somewhere and hands us money that someone else deposited. Savers deposit. Borrowers receive. Simple transfer. That is not entirely how it works. What actually happens, and this is the part that genuinely surprised me, is that when a bank approves a loan, it creates a new deposit in the borrower's account. Not by moving existing money, by creating a new entry. This is called fractional reserve banking, which simply means that for every amount of money held in deposits, the bank is permitted to lend out a larger amount. Not the entire deposit. A fraction of it is kept as a reserve, in case depositors want their money back, and the rest is put to work. Look at this flow diagram as it builds. $100 deposited. The bank keeps $10 as a reserve. $90 is lent out. The borrower spends that $90, which eventually lands in someone else's bank account as a deposit. That bank keeps $9 in reserve and lends out $81. And so the cycle continues. Watch the counter at the bottom of this diagram as the process repeats. That original $100 deposit, through this circulation, can support up to $1,000 of economic activity. Not through magic. Through the money circulation system, running exactly as it was designed to run. I remember the first time I watched this diagram and feeling a strange combination of fascination and mild indignation, as though I had been using a piece of infrastructure my whole life without ever being handed the instruction manual. If you have made it this far, and I genuinely mean this, the next part of what I'm going to show you is the piece I find most clarifying about the whole banking relationship. It is the part that answers not just why we put money in banks, but what we are actually getting in exchange for doing it, and whether that exchange is working in our favor. If you have not already subscribed, this would be a good moment, because the kind of financial clarity we are building here is exactly what this channel exists to provide. And what I found in the next layer of this system, when I looked at the numbers behind what banks actually do with deposits, was the part that changed how I thought about every savings account I have ever held. Stay with me. Here is the second mechanism. And this one is where the relationship between you and your bank becomes something you need to understand clearly. A bank has two types of customers. You're probably thinking of yourself as one of them. A depositor, someone who puts money in. But you are also, and this is the part most people do not fully register, a lender. When you deposit money in a bank, you are lending that money to the bank. The bank is the borrower. You are the creditor. The interest the bank pays you on your savings account is the interest rate on your loan to the bank. The bank then takes your loan, your deposit, and lends it to other people at a higher interest rate. Look at this bar chart. On the left, the average interest rate a bank pays you on a standard savings account. On the right, the average interest rate a bank charges someone who borrows money from it, whether through a mortgage, a personal loan, or a credit card. Watch both bars build simultaneously. The gap between them, that space between what the bank pays you and what it charges borrowers, is called the net interest margin, which simply means the bank's profit from the difference between its borrowing cost and its lending income. And that profit, that gap, is funded, in part, by the difference between what you earn on your deposit and what someone else pays to borrow it. I want to be clear. This is not a flaw in the system. It is the system. Banks are businesses. They borrow at a low rate from you and lend at a higher rate to others. The difference is how they operate, how they pay their staff, and how they generate a return. Understanding this does not make banks the enemy. It just makes you a more informed participant in the relationship. Stay with me, because the third mechanism is where the full picture comes together, and it is the piece that finally answered my original question completely. Here is the third mechanism, the one I think most people have never consciously examined, even though they rely on it every single day. Think about what actually makes it possible for you to trust that your money will be there tomorrow, not next year. Tomorrow morning, when you open your banking app and check your balance, why do you know it will be there? It is not because the bank kept it in a vault with your name on it. We have already seen that it did not. It is because of something that sits behind every bank, largely invisible, that most people never think about: the deposit guarantee system. In the United States, this is the Federal Deposit Insurance Corporation, known as the FDIC. In the United Kingdom, it is the Financial Services Compensation Scheme. In Australia, the Financial Claims Scheme. In almost every country with a functioning banking system, there is an equivalent. The idea is simple. If a bank fails, if it runs out of money, if it makes bad loans, if it collapses, your deposit is protected up to a guaranteed limit. When was the last time you genuinely asked yourself, not as a passing thought, but as a real question, why do I put my money in a bank? Not how, not where. Why? I do not mean the automatic, reflex answer that comes before the question has finished forming. I mean the actual reason, the deeper one, the one that would still hold up if you sat with it for a few minutes and really pushed on it. Because I asked myself that question a few years ago, sitting in my car, looking at a bank branch I had walked into hundreds of times, and I realized, with a quiet sense of embarrassment, that I did not have a satisfying answer. I had been putting money in banks my entire adult life. My parents put money in banks. Everyone I knew put money in banks. But why? At the level of how it actually works, what actually happens to the money, and what the relationship between me and that institution actually is, I genuinely could not explain it. And that gap between doing something every day and understanding why you do it, I think that is one of the most important gaps in financial education that almost nobody talks about. I want to take you through what I found when I started asking that question seriously. Not because the answer is complicated, it is actually surprisingly simple once someone lays it out clearly, but because understanding it changes how you think about your money, your bank, and the invisible system you have been participating in since the first time someone told you it was a good idea to open a savings account. I grew up treating a bank account the way most people do, as a safe box. You put money in, the money stays there. You take it out when you need it. That was my mental model for the first decade of my adult financial life. A very secure, very reliable, very official, safe box. The first time that model cracked was when I asked a simple follow-up question. If the bank is just holding my money, why does it pay me interest? What is the interest for? A safe box does not pay you for using it. A storage unit does not send you a check every month for keeping your belongings there. But a bank does. Or at least, it is supposed to. So something else was clearly going on. Something I had never properly thought to examine. I spend way too much time turning financial systems into data you can actually see. If what I am sharing today is useful to you, hit subscribe. It helps more than you know. Let me give you the clearest possible picture of what a bank actually is before any numbers, before any data. Because the right analogy makes everything else click into place instantly. Imagine a town that needs a well. Most people in the town have a small amount of water they have collected and stored at home. More than they need right now, but not enough to do anything large with on their own. And then there are other people in the town who need a large amount of water immediately, to irrigate a field, to build something, to run a business, but who do not have enough stored themselves. A bank is the well in the middle of that town. You bring your water to the well, your savings, and the well holds it. But the well does not just sit there. It takes the combined water of everyone in the town and lends it out to the people who need large amounts right now. In exchange for lending it, the borrowers pay back slightly more than they borrowed. That extra amount is called interest. The bank keeps some of that interest as its fee for running the well, and it shares some of it with you, the person who brought their water, as a thank you for making the whole system possible. That thank you payment is your savings interest. Your money was never sitting still. It was always the water in the well, circulating, being lent, being returned, generating a small return on its journey. The SafeBox model I carried for 10 years was not wrong exactly. It was just incomplete in a way that mattered. Here is where the picture becomes even more interesting, and more personal. According to the Federal Deposit Insurance Corporation's most recent data, there are approximately 4,600 commercial banks currently operating in the United States alone. 4,600 institutions all running this same well system simultaneously. Watch this bar as it builds, each bar representing a different country. And notice that the number of banks per country scales almost perfectly with the size of that country's economy. Not with its population, with its economic activity. That relationship told me something I had not consciously registered before. Banks are not just places where individuals store money. They are the infrastructure through which an entire economy moves. The moment I understood that, I stopped seeing my bank account as a personal safe box and started seeing it as a small but genuine part of something much larger. And what I found when I started looking at exactly how that larger system uses my money, I think you are going to want to see it for yourself.